Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of understanding bond yields and growing your money. Ever wondered how bond yields affect your wallet? Understanding bond yields is crucial for smart personal finance. Bond yields, the return investors earn on bonds, directly impact your investments and financial choices. Whether you're saving for retirement or planning big purchases, this knowledge can help you make better decisions. Navigate the world of bond yields with confidence and see how it can shape your financial future. Dive in and see how mastering this can boost your financial game. Understanding bond yields. When it comes to understanding bond yields, it's essential to grasp the basics before delving into more complex concepts. Bond yields play a crucial role in the world of investing, providing valuable insights into the returns that bonds can generate for investors. Let's break down the definition of bond yields, explore the different types, and delve into how these yields are calculated. Definition of bond yields. Bond yields refer to the amount of return an investor can expect to receive on a bond investment. It represents the interest or dividend earned on the bond relative to its current market price. In simpler terms, bond yields indicate how profitable a bond investment can be over time. Understanding bond yields is fundamental for investors to evaluate the potential risks and returns associated with investing in bonds. Types of bond yields. Coupon yield. The coupon yield, also known as the nominal yield, is the fixed annual interest rate paid by the bond issuer to the bondholder. It is usually expressed as a percentage of the bond's face value. For example, a bond with a face value of $1,000 and a coupon yield of 5% would pay $50 in annual interest. Current yield. The current yield is a measure of the bond's return based on its current market price. It is calculated by dividing the annual interest payment by the bond's market price. For instance, if a bond pays $50 in annual interest and is currently trading at $900, the current yield would be around 5.56%. Yield to maturity, YTM. The yield to maturity reflects the total return an investor can expect to receive if the bond is held until it matures. It considers not only the annual interest payments but also any capital gains or losses if the bond is purchased at a premium or discount to its face value. Calculation of bond yields. Calculating bond yields involves different methods depending on the type of yield being determined. For the coupon yield, it's a straightforward calculation based on the fixed interest rate and face value of the bond. Current yield is derived by dividing the annual interest by the current market price. Yield to maturity involves a more complex calculation that considers the bond's price, coupon payments, and time to maturity. Understanding how bond yields are calculated empowers investors to make informed decisions when building their investment portfolios. By analyzing the various types of bond yields, investors can assess the risk-return profiles of different bonds and tailor their investment strategies accordingly. Bond yields serve as crucial indicators of the potential profitability and stability of bond investments in the financial markets. Impact on investments. The fluctuations in bond yields have a significant impact on investments, shaping the financial landscape in various ways. Relationship between bond yields and prices. When bond yields rise, the prices of existing bonds in the market tend to fall. This inverse relationship is crucial for investors to understand, as it affects the value of their bond holdings. If an investor sells a bond before maturity when yields are higher, the bond may be sold at a discount, leading to a capital loss. Conversely, when bond yields decrease, bond prices typically rise, resulting in capital gains for investors. Risk and return trade-off. Investing in bonds involves a trade-off between risk and return. Bonds with higher yields often come with increased risk. Higher risk bonds, such as lower-rated corporate bonds or those with longer maturities, usually offer higher yields to compensate investors for taking on additional risk. On the other hand, safer bonds, like government bonds or highly rated corporate bonds, tend to have lower yields. Understanding this trade-off is essential for investors to make informed decisions based on their risk tolerance and investment goals. Diversification strategies in relation to bond yields. Diversification is a crucial strategy for managing risk in an investment portfolio, particularly in response to bond yield fluctuations. By spreading investments across different asset classes, including bonds with varying yields and maturities, investors can reduce the overall risk exposure of their portfolio. Diversification helps to mitigate the impact of sudden changes in bond yields on the entire portfolio, as losses in one asset class may be offset by gains in another. Moreover, diversification can enhance overall portfolio stability and potentially improve long-term returns. In conclusion, investors need to closely monitor bond yields and understand their implications on investments. By grasping the relationship between bond yields and prices, recognizing the risk-return trade-off, and implementing diversification strategies, investors can navigate the complexities of bond markets and make informed investment decisions tailored to their financial objectives. Bond yields and financial planning. Incorporating bond yields in retirement planning. Understanding how bond yields play a crucial role in retirement planning is essential for securing your financial future. Bond yields can provide a steady income stream during retirement, offering stability and predictability in an investment portfolio. By diversifying your retirement savings with bonds, you can mitigate risks associated with market fluctuations and ensure a consistent source of income in your post-retirement years. Effect of economic factors on bond yields. Various economic factors influence bond yields, impacting the returns investors receive on their bond investments. Factors such as inflation rates, interest rates set by central banks, and economic growth projections can directly affect bond yields. For instance, in times of economic uncertainty, bond yields tend to increase as investors seek safer investment options. Understanding these economic drivers can help investors make informed decisions when incorporating bonds into their financial plans. Understanding bond yields is crucial for any investor looking to grow their money through fixed income investments. Bond yields represent the return an investor can expect from a bond, and they play a significant role in the broader financial markets, influencing everything from corporate financing to personal saving strategies. Bond yields come in various forms, with the two most common being current yield and yield to maturity, YTM. The current yield is calculated by dividing the bond's annual coupon payment by its current market price. This yield provides a snapshot of the income an investor can expect if they purchase the bond at its current price. While useful, the current yield does not account for the total return an investor would receive if they held the bond until maturity. Yield to maturity, on the other hand, is a more comprehensive measure. YTM considers the bond's current market price, its coupon payments, and its face value, or par value, which is the amount paid back to the investor at maturity. YTM assumes that all coupon payments are reinvested at the same rate and calculates the total return an investor can expect if the bond is held until it matures. This makes YTM a critical metric for comparing bonds with different prices and maturities. Bond yields are inversely related to bond prices. When interest rates rise, new bonds are issued with higher coupon rates, making existing bonds with lower rates less attractive. Consequently, the prices of existing bonds fall, increasing their yields. Conversely, when interest rates fall, existing bonds with higher coupon rates become more attractive, driving up their prices and lowering their yields. This inverse relationship underscores the importance of interest rate trends in bond investing. Inflation is another key factor affecting bond yields. Inflation erodes the purchasing power of future cash flows, making fixed income investments like bonds less attractive. To compensate for this risk, investors demand higher yields on bonds when inflation expectations rise. This relationship between inflation and bond yields is particularly evident in the yields of long-term bonds, which are more sensitive to inflation expectations than short-term bonds. Understanding bond yields also involves recognizing the different types of bonds and their unique characteristics. Government bonds, such as U.S. Treasuries, are considered low risk because they are backed by the government. These bonds typically offer lower yields compared to corporate bonds, which carry higher risk due to the potential for default by the issuing company. Municipal bonds, issued by state and local governments, offer tax advantages that can enhance their after-tax yields, making them attractive to investors in higher tax brackets. Investors can use bond yields to build a diversified portfolio that balances risk and return. For instance, a mix of short-term and long-term bonds can help manage interest rate risk while providing a steady income stream. Short-term bonds offer lower yields but less price volatility, while long-term bonds offer higher yields but greater sensitivity to interest rate changes. Including bonds with different credit ratings can also help manage credit risk, as higher-rated bonds offer more security but lower yields compared to lower-rated, higher-yield bonds. Additionally, bond yields can serve as economic indicators. Rising yields often signal expectations of higher economic growth and inflation, while falling yields may indicate economic slowdown and lower inflation expectations. By monitoring bond yields, investors can gain insights into market sentiment and adjust their investment strategies accordingly. In conclusion, understanding bond yields is essential for growing your money through fixed income investments. By considering factors like interest rates, inflation, and the types of bonds available, investors can make informed decisions that align with their financial goals. A well-constructed bond portfolio can provide steady income, preserve capital, and offer diversification benefits, making it a valuable component of a comprehensive investment strategy. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.